Welcome to this week's series of Credent Connect. And today we're going to focus a little bit on the markets, some portfolio positioning, and maybe trying to future cast a little bit kind of what may happen, what may transpire relative to expectations. Now that the presidential election is behind us, we have a president-elect, and now the markets and investors in general are looking on to the next thing. And a couple of things we want to focus on today, but predominantly is kind of seasonality, Alicia. And seasonality simply refers to how do the markets react in each given month throughout the year relative to the previous year, previous 10 years, 20 years, and so on and so forth. December has usually been a very good month at Santa Claus rally, so to speak. But seasonality during election years tends to look a little different during November, December timeframe. Is that good or bad? What can we expect based on that pure historical structure?
So that's good for us because, like you said, typically December is a good month for markets, but typically on election years, it's even better, which allows us to position into equities and allows our portfolios to look really good towards the end of the year.
Yeah, absolutely. I think seasonality is your friend. The interesting thing about seasonality is attempting to fight that trend can result in more negatives than positives. And we are certainly taking that into consideration as we're nearing here year end. One thing that may derail that structure, right, as we're looking at the positive negatives, is our unexpected comments from the Federal Reserve. And as we know, there have been 2 rate cuts so far this year, one for 0.5%, 50 basis points, and one for 25 bips, about 0.25%. So that aggregate rate cut with an expectation now for December at roughly close to 50-50 for that were to happen. Is it possible that the rate cut doesn't happen and seasonality gets derailed? Or is it possible that rate cut does happen and there's a continuation of that trend down the road?
Yeah, I think there's a lot of factors at play here. There's been a lot of really strong economic data come through, and the Fed is looking at that. So as we have that stronger data, if we see inflation kind of hang around being a little bit more sticky, there is a probability that interest rates are not cut to the extent that the market is pricing in. And if that happens, we're going to have those higher yields, which are a negative to bond prices.
Yeah. From our perspective, the way we're looking at that is not only on an absolute basis of what's going to happen likely with interest rates, which we're managing very actively from a duration, right? Meaning how long does it take for a bond to mature, tracking that in the number of years, but also as a function of this kind of newly found rhetoric of a deeper potential recession over the next 12 months. And the reason we say deeper is because with the president-elect, right, part of the conversation has been tariffs that are likely to get reinstated, similar to what happened in the previous administration during 2017 to 2021, when the same administration was in office. The interesting part about that is, first of all, it's a rarity that we have an exact blueprint of what had happened previously in this administration with tariffs, but we have to gauge that on a relative basis to what may happen over the next 4 years. Conventional wisdom would have suggested from 2017 to 2021 that the inception of tariffs would have caused U.S. multinationals to perform poorly. It would have made the argument that U.S. small cap companies or mid cap companies, the ones that derive most of the revenue internally as opposed to outside of U.S. borders, that they would have performed better. And the reality is none of that transpired, right? So that blueprint, those guardrails that we have 4 years of data for, we know what that could be for the future, but we are certainly not using it as the sole basis for decision making because, as we found out from 2017 to 2021, things did not transpire as expected. So as we're gauging the economic backdrop over the next 4 years, and as you mentioned, the consumer still looks good, data is still coming in fairly positive. Earnings season, although it wasn't stellar, it wasn't bad. There was a continuation of that trend to the positive. We are taking that into consideration as we're making decisions for portfolios through year end. With that in mind, it bears significance to talk about portfolio positioning, right? The key takeaway here. What does this mean for you in your portfolios from a risk management, allocations? Let's talk a little bit about that positioning heading into year end, things we have maturing in the first and second half of next year. How are we assessing that, Alicia?
So when we look at our aggregate portfolios, we have a favorable view on domestic equities. When we look at things like earnings and we look at technicals and fund flows, very strong domestically versus internationally. So right now, that positioning is very positively overweight on that domestic front.
Yeah.
We're also looking at those global multinationals, the large cap space, as being very favorable. Earnings season, as you said, was really good, better than expected, and in the large cap space versus some of the mid and small caps. So we're keeping that overweight there. One of the things that we're doing as a hedge, as we talk about, okay, are we going to see higher rates? Are we going to see some sort of recession coming? Is a hedge on our equity market participation. And we're doing that through the use of structured assets. We have a 15% hedge there. We think it's a very timely decision, a very tactical decision. And that hedge is in place until May. At that time, we'll reevaluate and decide where we want to go going forward, whether it's a continuation of that hedge at that point in time.
And the investment team kind of put the hedge in place very timely with the expiration, so to speak, post the GDP release, the gross domestic product growth release, which would have been for that first quarter of 2025. So that'll be very timely for the decision making. And of course, on the international piece, we are underweight. We are going to play it out. And most importantly, we're paying attention to the dollar. Its recent rise, has been quite impressive. We have been hedged on that front and taken a very cautious view. And we'll be managing on a risk basis first, and then focusing on total return for your portfolios.